Everybody, this is lecture for week 8 and this is lecture 1, lecture for Tuesday. Okay, this you are still in topic number 5. In the previous lecture I have covered two subtopics in this topic 5. I have explained about horizontal analysis, and then after that I have explained about vertical analysis. So this is the part 3. This is the subtopic 3. This is about financial ratio analysis. In this topic, you are learning about financial statement analysis. If you can remember, in the previous lecture I have explained about what is the financial ratio analysis. It is about the way to analyze a business financial statement. I have told you in the previous lecture, if you see a financial statement, you only can make a general conclusion. For example, if you see the business asset is big or is a lot, then you can say the financial condition is good. Let's say you see a business, in the business income statement, the business is making profit, then you can say the business is good. That is the general conclusion. But if you want to make a good conclusion, an accurate conclusion about a business, you have to do financial statement analysis. So you have seen the way how to do financial statement analysis using horizontal method and vertical method. And this week, in this lecture, you will see how you can use financial ratio analysis in order to understand or to make accurate conclusion about a business financial statement. Okay, let's see. Okay, ratio is something I think you have learned about ratio in mathematics. If you have to calculate ratio, then you have to use one number compare with another number. That is ratio. So you can in doing the financial statement analysis, you can use financial ratio analysis, and there are many ratios that you can use to analyze a financial statement. I think hundreds of ratios. But in this course, you will be introduced to only 5 basic ratios. Okay, this is the first one. The first ratio that you have to know is called debt ratio. Okay, debt ratio, see the first point in this slide, debt ratio is a measure of leverage. Leverage is related to debts or borrowings. So this ratio indicates extent of borrowed money is used to grow the business and leverage owners' equity. As a general rule, all companies should have a debt ratio of 50%, around 50%. Okay, this is the formula to calculate the debt ratio. The formula is debt ratio equal to total liabilities over total asset. So if you want to do or to calculate debt ratio, you have to find these two data in the balance sheet. In the balance sheet, you see the balance sheet and you will see total liabilities. What is the total liabilities for a business, and then you also can see the total assets for a business. Okay, so let's say, see the small yellow box here. Let's say so how it works. So let's say you have calculated debt ratio for two businesses. So business A debt ratio is 35%. and business B is 28%. So which one is better? Okay, so remember this. For debt ratio, the lower the number, the better the business. So you can see the formula here, total liabilities over total asset. The lower the ratio, the lower the better the business. So for business A and business B here, business B is better in term of debt ratio. So another thing that you have to know about debt ratio is, in accounting we use 50% cut off. So if a business has debt ratio of 50% or below, we will say that the business is still okay in terms of debts or leverage. But if you see a business and then you found that the business debt ratio is more than 50%, then it shows that the business is not good in terms of debts or leverage. Okay, remember about the 50% rule or cut off. Okay, the second ratio that can be used to analyze financial statement is called current ratio. Current ratio is a measure of liquidity. Liquidity is related to the ability of a business to pay short-term debt. If you have a business, most of the time you will have many short-term debts. For example, you have to pay the supplier, you have to pay the utilities, you have to pay the accrued salary, for example. So you will have short-term debts. So current ratio can be used to measure the ability of a business to pay its short-term debts. This ratio also called working capital ratio. Okay, the formula to calculate current ratio is total current assets divided by total current liabilities. These two data also can be collected from balance sheet. Remember, financial statement contains 5 components: balance sheet, income statement, statement of equity, statement of cash flow, and notes to the account. So if you want to do current ratio, you can collect these two data to do the calculation from the balance sheet. So for current ratio, the higher the ratio, the better the business in terms of liquidity. So see the small yellow box there. Let's say business A liquidity is 1.22 and business B liquidity is 1.75. Which business is better in terms of liquidity? So the answer is business B is better. So remember, for current ratio, the higher the ratio, the better the business in terms of liquidity. So business B, the current ratio is higher compared to business A. So business B is better in terms of liquidity compared to business A. Okay, the third ratio that you have to know related to this cost is the return on sales ratio. So let's see. Okay, return on sales ratio is a measure of the amount of profit earned per dollar of sales. It shows how many cents the business get profit from selling its product or services. So if for return on sales ratio, you will know whether the ratio is good or not if you compare the ratio of a business with the industry average. Okay, let's see. So this is the formula to calculate return on sales ratio. The formula is net income or profit divided by sales. So for return on sales ratio, the higher the ratio, the better the business in terms of profit earned per dollar of sales. So see the small yellow box there, business J liquidity ratio, sorry, that one is supposed to be business J return on sales ratio is 12%. The market average for the return on sales ratio is 17%. So is it a good sign? So you can see here, like I said earlier, for return on sales ratio, the higher the ratio, the better the business in terms of profitability. So in this yellow box, business J is not good because business J return on sales ratio is 12%, but the market average is 70%. So business J profitability is less compared to the average in the market. Market average is the average of return on sales ratio for businesses in the same category with business J. Let's say business J is a supermarket. So business J is a supermarket. So the return on sales ratio for business J is 12%. But in average, the supermarket in the area return on sales ratio is 17%. So business J profitability is less than the market. So it is not a good sign for business J. That's how you can use return on sales ratio to analyze financial statement of a business. So how to get data to calculate this ratio? Net income or profit and sales data. So you can get these two data from income statement of a business. Okay, another ratio that you have to know is called asset turnover ratio. Asset turnover ratio is a measure of company efficiency. So the higher the ratio, the more efficient the business. So see here, the higher the asset turnover ratio, the more efficient the business in using its asset to generate sales. So the formula to calculate the asset turnover ratio is sales over total asset. The thing is like this. Let's say there are two businesses. Both businesses asset is $100,000. Business A, the sales is $250,000. Business B, the sales is $350,000. So which business is more efficient in using its asset? Business B is more efficient because business B use $100,000 asset and can generate $350,000 sales, compared to business A only sales only $250,000. So business B is more efficient. Business B can generate more sales using the same amount of asset compared to business A. So that's how or that is the logic how asset turnover ratio measure a business efficiency. So let's see in the blue yellow box there, small yellow box there, business A asset turnover is 3.7 times. Business B is 2.8. Which business is better in terms of efficiency? So the answer is business A. For asset turnover ratio, the higher the ratio, the better the business in terms of efficiency. Okay, and then this is, I think, ratio number 5, the fifth ratio that you have to know. So see, this return on equity ratio is overall measure of performance, profit earned per dollar of investment. Okay, remember, return on sales ratio measures profit earned per dollar of sales, but this ratio it measures profit earned per dollar of investment. So if you are an investor, you want to see the return on equity ratio, because you will know for every dollar that you invested in a business, or you will invest in a business, how much is the return. Okay, so the formula to calculate this ratio is net profit or net income divided by owner's equity of the business. I hope you can remember what is owner's equity. You have learned about that in topic 1, 2, 3, 4. And then when you prepare the balance sheet, you have learned about how to calculate the owner's equity, total owner's equity. Okay, so that's the calculation, that's the formula. So how to get the data if you want to calculate this ratio? Net income data can be found in income statement. Net income is net profit. Owner's equity data can be found in balance sheet. So you have to have income statement and balance sheet. Okay, so let's see the small yellow box there. Business A return on equity ratio is 23%. Business B is 19%. So which one is better in terms of performance, profit earned per dollar of investment? So business A is better in terms of return on equity. So for return on equity, the higher the ratio, the better the business in terms of return on equity. So for business A there, 23%, it shows that for every $1 investment, or for every $1 honest equity, the profit that can be generated is 23 cents. For business B, for every $1 of honest equity, the profit that can be generated is only 19 cents. So business A is better in terms of return on equity compared to business B. And then something that you have to know about return on equity is, if you want to invest in a business, make sure the ROE of the business is between 15 to 25%. So let's say in the future you have extra cash, so somebody asks you to invest in his business. So before you invest in his business, you can use this ROE. You check the income statement and balance sheet of the business, and then you calculate ROE. If the ROE of the business is between 15% to 25%, then most of the time it is a good idea to invest. Okay, If the ROE is below 15%, it is not a good investment, because if the ROE is below 15%, you can get that kind of return by investing in what? In trust fund. Many trust fund out there. You can put your cash there, and then you can sleep. At the end of the year, you can get return up to 15%, sometimes more, without high risk. If you invest your cash in a business, you want return more than 15%, because when you invest cash in a business, you take risk. The business can collapse, the market can collapse, the country economy can collapse. So when you invest cash in a business, you take risk. If you take high risk, when you take high risk, you expect to get high return. That's why if you want to invest, please, you have to invest in a business that can provide, or that in a business that has more than 15% or more return on equity. But you have to also know another thing. If you see a business has return on equity of more than 25%, you have to be very careful. Most of the time, if a business, if somebody says his business can generate or has ROE of more than 25%, then that is too good to be true. Too good to be true. Because normally, a very good business, cannot a very good business does not have ROE of more than 25%. More than 25%. That is the thing. When you invest, always remember, if somebody told you you can get return on equity more than 25%, be very careful, because most of the time that kind of return is too good to be true. Maybe it is a scam. So most of the time for businesses, typical businesses, the ROE is between 15 to 25%. That is the good ROE. Less than 15%, it is not good. More than 25%, most of the time, it is too good to be true. So let's say there is a question something like this. Business X return on equity is 22%. Business Y return on equity is 28%. So which business is better in terms of return? So the answer is business X. Business X is better, 22%. Business Y, it has 28% of ROE, but it is too good to be true. Maybe maybe there is something wrong in the calculation or something. So that's how you use this rule for ROE between 15% to 25%. Always say a business that has ROE between this range is better compared to other numbers. Okay, so business X has 22% ROE. It is better to invest in business X. Why not invest in business Y that has 28% ROE? Because according to the rule that we have in accounting, if the ROE of a business is more than 25%, most of the time it is too good to be true. Okay, this is price earning ratio. Price earning ratio is a ratio that is a measure of growth potential, earnings stability, and management capabilities. This ratio is not compulsory for you to follow or to know in this course, because to calculate the price earning ratio, you have to know the market price per share and also earnings price per share. So shares is related to companies, but in this course you only learn about sole proprietorship, service business, so it's not important. But if you want to know about the price earning ratio, it is good to know about this, because let's say in the future you have extra cash, you want to purchase shares, business shares, company shares such as Alibaba shares or any big businesses shares. So before you purchase the shares, better for you to see the price earning ratio of the business. I heard that the higher the price earning ratio, the better the business. It shows that if the price earning ratio is high, the capability of the business to give good return to the investor is high. But if you want to know more about this price earning ratio, you have to read about this ratio in finance textbook or other sources. It is very useful. I think most investors, most share investors, they will see price earning ratio first before they invest. Okay, these are the 5 ratios that you have to know in this course. Okay, these are the 5 ratios. See, the first ratio that you have to know is debt ratio, second current ratio, third asset turnover ratio, the fourth ratio is return on sales ratio, and then the fifth ratio is return on equity. You have to know these 1, 2, 3, 4, 5 ratios. You have to know how to calculate the ratios, and then you have to know how to interpret the ratios. So you have to memorize the formula. There is no other way. So debt ratio is total liabilities over total asset. Current ratio is current asset over current liabilities. Asset turnover ratio is sales over total asset. Return on sales ratio is net profit divided by sales. Return on equity is net profit divided by owner's equity. There is no other way. You have to memorize the formula, and also you have to know how to interpret the ratio. You have to know if the ratio is high, is it good or not. For example, debt ratio. The higher the debt ratio, the lower the debt ratio, the better. But for current ratio, the higher the current ratio is better in terms of liquidity. Debt ratio is in terms of leverage. Okay, this is another way to analyze financial statement. You can use common size financial statement. Common size financial statement is something like this. You convert the financial statement, for example, the income statement, in terms of percentage. When you convert the income statement using the in terms of percentage, you can see clearly, oh, this is good or not. then it is better when you compare several companies, company A, company B, company C. So you can see the profit, how many percentage of the profit. For example, company A 25%, company B 23%, company C 31%. So which one is better? 31% is better. So when you convert the numbers in terms of percentage, it helps you to make better conclusion when you compare the income statement. Okay, it is raining here. I hope you can hear the things that I want to say. So even you have learned about 3 methods that can be used to analyze financial statement: horizontal method, vertical method, and financial ratio method. These are good method. These methods can help you to analyze financial statement and also can help you to make accurate conclusion about business performance, profitability, debts, and efficiency. Very good. But there are several limitations. Okay, the first limitation is financial statements do not contain all information. So remember, the thing that you have learned is you learn the way to analyze financial statement. But you have to aware that financial statement does not contain all the information. Financial statement contains dollar and cent information only. But financial statement does not contain information about customer loyalty, good location or not, customer satisfaction, etc. Okay, so just aware about that. Okay. And then C number 3, lack of comparability between companies. I have said earlier, if you want to make when you want to make the analysis, you can compare company A, company B, company C, company D. But you have to aware that there are no two same companies. For example, let's say in Malaysia we have at least four big telecommunication companies. So in a simple way, we can say that if I want to analyze company 1 in the telecommunication business in Malaysia, then I can compare the data company 1, data company 2, company 3, and company 4, because they are same categories. They are in the same categories, telecommunication industries or telecommunication companies. That is the general idea. But if I check in detail, these 4 companies are actually very different. One is maybe it is like this. One is owned by Malaysian 100%. Another one is owned by company investor from not from Malaysia, but they operate in Malaysia. Another one is joint venture, or around 50% owned by Malaysian, another 50% owned by foreign investor or foreign company. So even though they are in same category, we have to aware that every business is unique. We can compare, but still we have to be very careful when we want to make a conclusion about the comparison. Number 4, not all problems are readily apparent. Okay, there is another thing that you have to aware when you do financial statement analysis. When you do financial statement analysis, let's say you do the analysis today. Maybe when you do the analysis today, you see everything is fine with a business. But after several weeks, the business bankrupt or collapse. The business things like that can happen. Because this is the point, because not all problems are readily apparent. If sometimes everything is good with a business when you do the analysis, maybe because you use the data that you use to do the analysis is not a new data. For example, you choose company A, you want to do financial statement analysis. The latest data is data at 31st of December 2020. So now it is already May 2021. So the data is 5 months back. So you do the analysis using the data that are 5 months back. So when you do the analysis, everything is good. But suddenly, the company can collapse because the data is not the latest data. That thing also can happen. And okay, and the last point here, point 1 is related to point 2. Okay, so and then point number 3, lack comparability. Point number 4, not all problems are readily apparent. Number 5, financial statement analysis is based on past performance. So always aware about this. When you do financial statement analysis, everything that you have done is using past data, is historical data. But you are trying to predict the future of the business. So you have to aware that maybe in some situation in the past the business is very good, but we do not know certainly about the future. We can make conclusion from the analysis, but we have to still aware that something bad can happen in the future, unexpectedly. Okay, thank you very much. This is the end of part 1 lecture. Do not forget to write your name and matric number in the comment section. That I will take that as your lecture attendance. Thank you very much.